All right, let's talk about your money, because something big is happening. For the first time in what feels like forever, those interest rates, the ones that have been at their highest in over 20 years and squeezing all of us, well, they're finally about to start coming down. So let's get into what that actually means for you.
Yeah, that's right. The Federal Reserve has been jacking up rates like crazy to fight inflation. Now, they're finally getting ready to hit the brakes and go in reverse. And on paper, that sounds amazing, right? It should mean lower costs for pretty much everything. Credit cards, mortgages, you name it.
So, is it time to pop the champagne? I mean, lower borrowing costs for everybody. Should we all be running out and planning those big purchases we've been putting off? Is the party starting?
Well, hold on a second. It's not quite that simple. The real story is, a little more complicated. But there's this one perfect metaphor that just nails what's about to happen.
It comes from Greg McBride. He's a chief financial analyst over at Bankrate, and honestly, this one line tells you everything you need to know for the next few years. He said, interest rates took the elevator going up, but they will take the stairs coming down.
And this chart, it shows you exactly what he means. Look at that huge jump on the left. Bam! That was the elevator ride up, fast and brutal. Now look over on the right at those planned cuts. See how tiny they are? Those are the stairs, just these small, slow, gradual steps down. So yeah, relief is on the way, but it's going to be a long, slow walk down.
So the big takeaway here is you got to be patient. A couple of tiny rate cuts this year, it's not going to magically slash your credit card bill or your mortgage payment. Financial planner Chris Diodato puts it perfectly. Don't jump the gun. The real meaningful change is going to take a couple of years to feel. So the question is, what can you do right now to get ready?
Okay, let's dive in, and we'll start with the big one for most people, your home.
All right. So if you're in the market to buy a house this year, you're going to hear about paying points to buy down your mortgage rate. It sounds tempting, right? Pay a little extra upfront for a lower rate, but you really need to think twice about this one. You could be spending thousands of dollars today for a teeny tiny discount, only to turn around in a year or two and spend thousands more to refinance when rates are much, much lower. A lot of the time, the math just doesn't work out.
So what about a HELOC, a home equity line of credit? Remember when those were like a source of super cheap money? For years, when rates were basically zero, it was a no-brainer. Well, you can forget about that. Those days are long gone. And even with the Fed slowly cutting rates, these loans are going to stay expensive for a good long while.
I mean, just look at this. Right now, the average rate for a HELOC is somewhere between 9 and 11%. That is absolutely not cheap money. So if you're carrying a balance on one of these, the advice from all the experts is crystal clear. Get aggressive and pay that thing down. That high interest rate isn't going away anytime soon.
All right, next up, let's talk about the big one, the one that keeps a lot of us up at night, high-cost debt. I'm talking about credit cards.
Just look at that number. Over 20%. That is the average record-high interest rate on credit cards today. It's insane. And let's be real, a few tiny little rate cuts from the Fed, they're barely going to touch that. This is an area where you have to take matters into your own hands.
So, here's your game plan. It's a simple two-step process. Step 1, hunt down a 0% balance transfer credit card. This is your secret weapon. It gives you a break from interest, usually for like 12, maybe 18 months, so you can just hammer away at the actual debt. Now, if for some reason you can't get one of those, don't sweat it. Move on to step 2. Go check out your local credit union or a smaller community bank. You'd be shocked. Their rates can be literally half of what the giant banks are charging.
Okay, so we've talked a lot about debt, but what about the other side of the equation? What do these falling rates mean for your savings?
It's been a pretty sweet time to be a saver, hasn't it? A lot of these high-yield savings accounts have been paying out over 5%. It's been so nice to actually see our cash working for us for a change. But you know what's coming. As the Fed starts that slow walk down the stairs, those juicy rates are going to start to disappear.
And this brings up a whole new kind of risk. Financial planner Chris Diodato calls it the cash trap. It makes total sense, right? When you could get 5% risk-free, it was really tempting to just pile all your extra money into savings accounts. The problem is, a lot of us stopped investing for the long term. And now that strategy needs a serious update.
So here's your new savings playbook. Rule number 1, and this is non-negotiable. Make sure your emergency fund is solid. That means having 6 to 12 months of living expenses tucked away in a savings account you can get to easily. After that's covered, you need to be careful about having too much extra cash just sitting there. Why? Because as rates fall, that cash earns less and less, and it can actually start to drag down your overall net worth. Now, there is an exception. If you're getting close to retirement, you have a really cool opportunity right now.
You can lock in some of today's still pretty high rates with longer-term CDs. Just make sure you get non-callable ones. That's key, because it means the bank can't just cancel it on you when rates drop.
So at the end of the day, just remember the big picture. That crazy elevator ride up with interest rates, that's over. But the slow, steady, one step at a time walk down the stairs, that's just getting started. And the real question is, are you prepared to take the stairs?